webinar is being recorded.
Good morning. Welcome everyone participating in this morning's webinar, Implementing ASU 2016-14, Presentation of Financial Statements of Nonprofit Entities. My name is Tom Netznick, and I am a nonprofit supervisor at Gelman, Rosenberg Freedman. I'll be moderating today's event. I'd like to start today with some quick housekeeping items and explain what participants need to do to earn CPE for today's webinar. Quality. We highly recommend you connect instead of your computer. If you have technical questions or issues during the webinar, please use the Q&A function to speak to our webinar administrator for assistance. Technical assistance is also available from WebEx at the number shown here. The webinar will be recorded and available on our website following the event. Slides are also posted at this address, www.rfcpa.com/webinars. Webinar seeking CE credit for this presentation must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. Please CPE words when they are given. They will be provided again. You will be added these words in order to receive credit. If you have a pop-up blocker, please take a moment and disable it now so it will not block the survey. Any questions about the survey may be addressed to Dominic Acosta at grfca.com. Our implied learning objective is to provide attendees with a better understanding of ASU 2016-14. Once credit is available to attendees of today's webinar. Today's webinar are Terry McKnight and Amy Boland. Terry, nonprofit audit partner and director of Gelman, Rosenberg Freedman CPAs, with a primary focus in auditing and consulting for organizations within the nonprofit industry, including private volunteer organizations, trade, member associations, international non-governmental organizations, community-based entities, museums, private foundations, and other charitable institutions. Amy, profit audit partner of Gelman, Rosenberg Freedman, and specializes in audits of nonprofit organizations, including associations, voluntary organizations, and charitable institutions, specifically 501c3 nonprofit organizations across a spectrum of cause areas. And with, I'm going to turn it over to Terry McKnight.
Thank you, Tom. Good morning to everyone. I'm happy to be on the call today to talk about the ASU 2016-14 presentation of financial statements of non-for-profit entities. Our goal for today is really to give you an overview of the key changes, help you be prepared for the implementation of the new standard, and to provide you with some examples of early adopters. These examples did not come from any of our clients, and we're not suggesting that this is the exact language or method to follow. However, they are intended to provide you with some information on what they're doing in the industry that have already implemented the new standard. So, why is the new standard, implemented? So, for the last 2 decades, as we all know, nonprofits have been following Topic 58 from FASB, preparing and reporting their financial information. It started with the FASB Not-for-Profit Advisory Committee and other stakeholders when they began politicking for better information. They thought the reporting process for the industry group was okay, but it could be much better and provide more useful information to the donors, to grantors, creditors, and others of the financial statements. So when we put the project out for comment, which ended back in August of 2015, so that was some time ago, there was a tremendous amount of pushback from the community, which resulted in redeliberation, and then the project was divided into two work streams, Phase 1 versus Phase 2. ASU 2016-14 is the finalization of Phase 1, which is to be implemented, and it certainly has had a major change to the financial statement presentation for nonprofits. So this update makes several improvements to the current reporting requirements that addresses just the overall complexities, deficiencies, and inconsistencies amongst the non-for-profit groups. There are some complexities about the use of the currently required 3 net asset classes that focus on the absence or presence of donor-imposed restrictions, and those restrictions are temporary or permanent in nature. There are deficiencies in the transparency regarding an entity's liquidity. And it could be caused by a misunderstanding or confusion regarding the term unrestricted net assets and how those restrictions were either imposed by donors, by governing boards, or even laws and contracts, and that does affect the entity's liquidity, their classes of net assets, and just the overall financial performance. And then some inconsistency and information provided regarding the type of expenses by function and classification, and overall difficulties in preparing the indirect method reconciliation if a non-for-profit chooses to use the direct method of presenting their operating cash flows. ASU 2016-14 was finalized back in August of 2016, and the standard does apply to nonprofits, which includes those non-governmental entities such as the charities, foundations, colleges and universities also must apply, healthcare providers, cultural institutions, religious organizations, trade associations, and other non-for-profits. Freedman have been discussing the standard with our clients for some time now, and the ASU has been included in Note 1 to our client's financial statement as a standard that is on the horizon to be implemented. So hopefully this slide is not new in information for most of our participants on the call today. The timeline is, when is this ASU effective? So it does start for annual financial statements with fiscal year beginning after December 15th of 2017 and interim periods within fiscal years beginning after December 15th of 2018. What does that mean? So if you are a December year end, the standard became effective for you January 1 of 2018. So currently, all December year ends are under the new standard. For a fiscal year end, you will implement for your 2019 year end. So, for example, if you are a June 30th year end, the ASU becomes effective starting July 1 of 2018 for your fiscal year. When you apply the new ASU, you must apply on a retrospective basis, and you have to apply all the provisions in the year of adoption. Must disclose the sum nature of the reclassifications or restatements and their effects, if there are any, on your financial statements. And organizations that show comparative years when they present their financial information, again, you must apply the ASU retrospectively for that future year that's being presented also. However, you can elect not to include the disclosure regarding liquidity or the expenses by nature and function for that prior year information. And everyone has had the option to early adopt if they want. And I think for those December year ends, it might be a little too late unless you are just getting ready to have your December 2017 year end audit. But there is time for those fiscal year ends to get an early adoption if they do choose to do so, if they are getting prepared for their upcoming audit. You'll know that organizations with calendar year ends are under the ASU because it did become effective January 1 of this year, 2018. We're going to have our first polling question. So the first question here has anyone with a December year end did their internal reporting to reflect the new ASU. So A is yes, B is no, and C is not applicable because you have a different year end. So let's give everybody a moment to answer the questions. And it is answering that polling question. I'm also going to give you the first CPE word of the webinar. So the first CPE word is audit. Again, the word is audit, A-U-D-I-T, audit. So I'm not seeing what the results are. I might have to turn it back over to Tom if he can see the results of the polling questions is coming in. So it looks like there's only 7% that have marked yes, that they have updated their internal reporting to reflect the new issue. So 10 out of 142 participants this morning. 51 has indicated that no, they have not updated their reporting, and another 36% says it's not really applicable to me, and a couple people have not answered. So if we have a follow-up question to this for those that have updated their internal reporting, and we want to know, has it been well received by management and or your board? So again, the A is yes, B is no, C have not updated the internal reporting. So here, it's important that because this is the new issue to really, hopefully, the management and your board understands what those changes are, and they have received the new financial information and understand those changes. So we'll have a couple of seconds here just to have everybody the opportunity to answer this polling question number 2. People have not updated the internal reporting. About 43% have not updated, and so the ones have answered yes. It's only about 5 out of 143, so 3% says that it has been well received by management. So that's very good. So the question here is, if you are a December year-end, or the statement here is that if you are under the new ASU, you should start thinking internally about updating that reporting so that you are using the right terminology, any changes that ASU will have to your financial statements. So there's not really big changes between your current reporting and when you have your audit at the end of your calendar year. Slide is just really designed to give you a snapshot of some of the key areas of the provision. And we're going to, in the following slides, kind of dive into a deeper dive into these different particular areas. But just as a quick snapshot, the provision of the ASU are in the net asset classification. It is changing the net assets from 3 classes to 2 classes of net assets. It's going to require some board-designated net asset disclosures. That's going to, you have to tell what the board has done with those designated net assets. One of the changes is in the reporting of underwater endowments, and it is going to require the place in service options for expiration of capital restrictions. From the inside, there's going to be some changes or requirements regarding the reporting of expenses by nature and by function. There are going to be some changes in the presentation of investment expenses against the investment returns and changes in those disclosure requirements. There will be enhanced disclosures around cost allocations. Liquidity is another big change. There's going to be a qualitative and quantitative disclosure regarding nonprofits' liquidity. And then also touch base on the statement of cash flows, the direct versus the indirect method. So let's go to the net asset classes. So currently, as we all know, for the last 20-some plus years, we've been using the word unrestricted net assets, temporarily restricted net assets, and permanently restricted net assets. And unrestricted net assets does include those undesignated and board designated and really represents the operational reserve of the organization. Temporarily restricted net assets represents those assets that are restricted by donors, either for purpose or time. And those permanently restricted net assets are those that must be invested in perpetuity, and the accumulated investment earnings get to be utilized for the organization. So under the new ASU, going from 3 net asset classes down to 2. And so the FASB has taken the unrestricted net assets and is now classifying it as without restrictions. And the second net asset class is now going to be referred to as with donor restrictions, and you're going to combine those temporarily restricted net assets and the permanently restricted net assets into that one net asset class. There are 2 classes of net assets. There are some required disclosures, and usually within the summary of accounting policies and procedures within the notes to your financial statements, you sort of talk about the net asset classifications. So the first net asset class, again, without donor restriction, it does include those undesignated net assets. It includes the board designated net assets. And now you must disclose the amount, purpose, and any type of board designation as part of the required disclosures. Net asset class with donor restrictions, you're going to disclose the nature and amount of the donor and timing restrictions at the end of the period and how the restrictions affect the use of resources. Also going to include endowments invested in perpetuity under those with donor restrictions, as I mentioned in that previous slide. And the big tier, you're also going to include underwater endowments. And I'm going to do a bit of a deeper dive in those underwater endowments in just a minute, so I'll hold off for giving you a little bit further clarification regarding that. So just an example that comes right out of the FASB itself. Here they include this in the ASU, and it's just a kind of a snapshot of the statement of financial position. And as you can see towards the bottom where they have the net asset category, so you have your assets at the top and obviously the liabilities and net assets. So here you can see where they marked through the unrestricted, temporarily restricted, and permanently restricted and replaced it with the 2 new net asset classes and restate those balances. So it's with donor restrictions and with donor restrictions. So we just included this because it is truly right out of the FASB, and you can easily pull that up on the web. But we want a little bit deeper dive of what you could possibly do within the net asset section of the statement of financial position. So start to the far left. There are topic 958, or the old SAS 117, we have the 3 net asset classes that we all know and love: unrestricted, temporarily restricted, and permanently restricted. And as you can see here, it has given you the total net assets of $5,250,000 broken out by the 3 net asset classes. So that's under the current. The middle box gives you the new ASU presentation amplified version. Here you can see that the net assets have been reduced down to just the 2 net asset class without donor restrictions and with donor restrictions. Without donor restrictions in this middle box is just the unrestricted assets of $2,250,000, and the with donor restriction is the combination of both the temporarily restricted and the permanently restricted. So if you put those together, you get the $3 million for total net assets of $5,250,000. So again, this is a simplified presentation that you could have on your statement of financial position. So then we do the third box all the way to the far right, and this is a more robust presentation that you can actually include on the face of the statement of financial position. So again, the net assets are broken down between the 2 net asset classes without donor restrictions and with donor restrictions. However, under each net asset class, we're showing a little bit more detail of what comprises within those restrictions or without restrictions. First one, it does break down. There are some board designated, and there's two types of board designated. There's board designated for operating reserve, and there is board designated for the endowment. So it probably reflects both of those designations as well as the undesignated to get to the total without donor restrictions of $2,250,000. Then to the second asset class, which is with donor restrictions, and again, it gives the detail of what's comprised of the with donor restrictions. Perpetual in nature, those are those endowed funds of $2,500,000. And then it nicely states out that there is a purpose restriction, which is given by the donor of $300,000, and timing restriction for future periods of $200,000 to get to that total donor restrictions of $3 million for the net assets of $5,250,000. So I think the important thing here is to note is that every organization, can present on the new ASU a simplified version, or they can do a robust type presentation on that statement of financial position. If they decide to do the simplified presentation, you must disclose within those notes of the financial statements what the designation are, whether it's for board designated or for donor restrictions. So in those financials, you must make sure that that is properly disclosed. So here it gives you some options. So this first example of a disclosure within the summary of significant accounting policies by an early adopter. So again, this is not a GRNF client, but this is already out that has been presented by an organization. And we just wanted to kind of give you a couple of examples of what they are doing. So this, again, is the addition of the net asset classification, which is usually in Note 1, your summary of significant accounting policies. So this is a copy right out of their audit report. And here it's saying, in that very first paragraph, they do a little bit of an introduction to say that the assets, revenue gains and losses are classified based on the existence or absence of donor or grantor imposed restrictions, and as follows, and then gives you a paragraph on the net assets without donor restrictions and assets with donor restrictions. And that one, the net assets without donor restrictions, they do need to know that the assets are available for general operations. They're not subject to donor restrictions. It also provides you disclosure regarding the board designations, and in this particular case, it talks about the board having an operational reserve for the organization. And the net asset class with donor restriction, here it highlights that these contributions are restricted by the donors, and they increase the net assets with that donor restriction if the restriction expires in the reporting period in which the revenue is recognized. It also talks about the donor restricted contributions are recorded as increases in net assets with the donor restrictions, depending on the nature of the restriction. And once those restrictions expire, the net assets will be reclassified out as a release in the combined statement of activities. So you can read these, this example one word for word and kind of get an idea of what this particular organization did. And the second one, there is an example two. It's a little slightly different wording. So we would give this to you as a kind of snapshot of what other people are doing at this, who have early adopted. And so in this particular example, under the basis of presentation, they also make reference to the accrual basis of accounting and that the financials are in accordance with GAAP. And that pretty much says the same thing as the one previous, where the assets, support, and revenues and expenses are classified based on the existence or absence of donor-imposed restrictions. And then it goes on to give you without donor restrictions and with donor restrictions. So it gives you a glance at what other people are doing. A couple of different examples relates to net asset classification. The underwater endowment. This is truly one of the major changes in the new standard. And under the existing GAAP, or for those that are have a December year end, it's considered GAAP, that unrestricted net assets had to bear the burden of underwater endowments. So under this new ASU, that is truly no longer the case. So under ASU 2016-14, our underwater will be included in the net asset classification with donor restrictions. So that in itself is a big change. You will still have to have the required disclosures regarding a non-for-profits policy and any actions taken during the period. You have to disclose the aggregate fair value of the endowed funds and the aggregate original gift amounts. So those will be required disclosures around those underwater endowments. And here's another kind of snapshot of what an early adopter did within one of its endowment disclosure. So under UPMIFA, the Uniform Prudent Management Institutional Funds Act, we are required to report out that the organization has adopted UPMIFA and then do a net asset roll forward of the endowment from the beginning of the year to the end of the year. That has not changed. But what has changed here, as you can see, you only have the two net asset classes, without donor restrictions and with donor restrictions. So the first one, let's just focus on the first column first. So that without donor restriction represents only board-designated endowments. So it's those quasi-endowments. In this particular instance, they started off the year with $0.3 million. They added some investment returns of $266,000. They appropriated some endowment funds for expenditures of $236,000. They had some other changes of $67,000 that got them down to an ending endowment balance of $3.4 million for their board designated. If you do the second column, the one with donor restrictions, you can see that with donor restriction includes the original contribution that must be invested in perpetuity, any type of accumulated earnings that have not yet been authorized for spending, and it also includes any underwater endowments. So in this particular case, it started the year with just shy of $67.6 million of total endowed net assets. It had investment earnings of a little over $7 million, new additional contributions, which must be, again, invested in perpetuity of $1.8 million, the appropriation of endowments for expenditure of $5.2 million, other changes of $126,000 to get down to the just shy of $71.1 million. But what's important here is if you go down into the section underneath, they highlight very nicely what is required, because in this particular portfolio of endowed gifts, they are in an underwater endowment situation. So there were funds that had an original gift value of $41.5 million, now only has a fair value of $34.8. So there's a discrepancy there. It's not worth as much as it was when it first came in. So there was a deficiency of $6.6 million. So under the old GAAP, that $6.6 million would have been included in unrestricted net assets. That's no longer the case. That $6.6 million has been reduced with donor restrictions, which is a big change associated with this new ASU. I'm going to go over to the statement of activities, and I am going to turn it over to Amy.
Thank you, Terry. I'll go through some of the remaining items of 2016-14 and go through some more examples, including FASB examples and some of the early adopter samples. Hopefully, this will help you come up with ideas to implement on your financial statements. And first and foremost, here we have the example of the FASB example from the Statement of Activities and Change in Net Assets. And it's pretty straightforward when you take a look at it. You can see here that there's columnar financial statements as we've always presented, but we have now changed those column titles to without donor restriction and with donor restriction to match exactly what Terry was presenting on the statement of financial position. And Terry mentioned as well, presentation is going to vary for many different clients. And one thing that I would point out on the FASB example here is net assets released from restriction. You can see that there are various breakouts of the satisfaction of these releases. Some are program related, some are time related, some have to do with the endowment. And ultimately, this will be up to you, again, if you want to put this detail in financial statements themselves or include that in the footnote. And this that'll be very important no matter where you put it, is this is going to come into play when you have to do your liquidity disclosure, which we will discuss in a minute. It does show your functional breakout here at the bottom under the program management, general, and fundraising piece, which you will as well. So if you had 3 columns in the past, you will now be down to presenting 2 columns. Piece go into are the classification of these expenditures. The new 2016-14 requires that you now present functional expense statement. So in the past, you may not have presented this. Some of you have before, so this won't be a huge change for you. But this is including this presentation now that has the NAV classification, the line items, salaries, benefits, taxes, travel, etc., and then your functional categories, your program, your M&G, and your fundraising. This has to now be presented a few options on face, a statement of activities, a separate statement, or notes to the financial statements. No longer be presented as a supplemental schedule behind the footnotes. So if you had it there, you will have to move the placement of those. Wouldn't be that difficult, but if you do have one in place, that'll require a little more work in producing that type of statement. Into this, the new requirement requires that you disclose the methods being used to allocate the costs between the program and supporting functions. And we'll look at a few samples of those. And under the new ASU, it does now require you to report investment return, external and direct internal investment expense. So for the ASU, not-for-profits were allowed to report investment expenses on the of activities either against investment return as a component of the expenses. Now, under the new ASU, the not-profit is required to report those directly netted with the investment return. And as I mentioned, it does say the net of external direct and direct internal. External expenses are those amounts paid to the third parties to generate the investment return. Internal investment expenses are those expenses that are involved with the direct conduct or direct supervision of the activities involved with generating that investment return. Direct internal expenses may include salaries or other costs that are associated with the staff who are responsible for the development and execution of your investment strategy, or to be a cost associated with supervising and monitoring those external investment management firms. Ultimately, the ASU has eliminated the requirement to disclose the composition of that investment return. And it has also eliminated the requirement to disclose the amount of investment expenses. So past many times you would have seen that in our note disclosure under the investments where we would have broken out the interest, the realized, the unrealized, etc. That is no longer required. In addition, if you have endowment funds, the forward schedule in the endowment disclosure now only needs to present that net investment return. It does not need to present the components. These changes were supposed to provide a more comparable measurement of investment returns across not-for-profits. As we mentioned, we have some additional examples from early adopters, and this I'm going to go through next is samples on the disclosing the methods of the allocation. This disclosure should be brief. It should focus on the more significant natural categories that are allocated. And in example 1, I think this one is a little light, but it does identify here for you the primary program service. It identifies the expenses that they consider support that program service, and that there are expenses that support more than one function that they are allocated based on the functions benefited. Example 2, and I think the rest of the examples we go through, the beginning piece of it really is sort of a similar note that we normally provided in the financial statements about the fact that there is an allocation process going on. In example here, in example 2, it does show you that the direct costs are basically allocated and charged to the program where it was originated. And then indirect costs, in this case the largest being payroll, are allocated to programs and support services based on an informal time study. This one is obviously labor-related, labor-driven, but as they say, an informal time study, I'm assuming that means that ultimately they do not keep timesheets on a regular basis and have come up with some sort of way of allocating this on, as it says, maybe it was a timesheet for a few months or some other way for their time study. Again, these aren't FASB, but they are something you can use to look at. And 2 more examples for this. And in example 3, it does say that they are allocated based on time and effort, so the salaries and benefits, as well as square footage. So it does identify that depreciation, office, and other occupancy and other expenses are based on the square footage. To time as well, which is probably going to be very common, but this one here does say that and their expenses are directly reported those specific areas that they belong to, and those that are indirect in nature are allocated based on either the number of employees involved or the amount of time spent in that area. And just a in case somebody does not have a functional expense statement, I wanted to just put this in here to let you what an example is. And obviously we have our natural classification down the left-hand side, the salaries, occupancy, printing, and then our functional classification in the columns go across the top. You can also split out your program services. You could identify various areas, as many as you would like. And your supporting services here, the general administration and the fundraising. And as we mentioned, I think probably most of these end up behind the statement of activities before the cash flow and the notes, but you can put them in the note or on the face of the financial statements themselves. And what I'd say is if you don't already have one of these in place, the thing you need to be working on right now, you're going to want to be able to customize this and work with your accounting systems to be able to produce this report. It looks probably similar to something you've done in the past for your 990 if you haven't presented it in your financial statements, but the 990 has specific areas already laid out for you, and this one you can customize and put as many categories as you want or as little, as long as you have the basics on here. I'm going to move on to the new liquidity disclosure. This, I think, is going to take a lot more time and thought in the process of implementing the new ASU. It is qualitative and quantitative in nature. What it does is it does discuss the disclosure around the non-for-profit and it manages its liquidity. And really the first piece of it, and that's the qualitative piece, where it's going to be primarily narrative in nature, and it's going to disclose and describe what the nonprofit does to manage this liquidity. There's a quantitative portion that goes along with it too, and this is about the availability of the nonprofit's financial assets. So basically, you have to determine, as of the date of statement of financial position, the financial assets that will be able to meet the cash needs for the general expenditures within 1 year of the financial statement date. So what are the financial assets? These are tangible, liquid assets that do have restriction by the donor or the board. And examples are normally your cash, receivables, investments. Things that would not be considered a financial asset are those that are not liquid, the fixed assets, the inventory, and of that nature. But ultimately, what it comes down to is identifying what is then available for general expenditures in the next 12 months. And there are various pieces that will cause a financial asset to be unavailable for general expenditure in the coming year. It may just be the nature of the financial asset. If a receivable that won't be collected in the coming year, then that's in theory not available for general expenditures. External limits, internal limits. And external is if, for example, a donor restricts something, maybe it's purchasing a new building, and that is not happening within the next 12 months. That is not available to be used for general expenditures. However, you can have external limits that will possibly be met in the next year. So management's going to have to apply judgment in this situation and decide if this restriction is going to be clearly utilized in this coming year to carry out the programs. And it is the same for internal. There are board designations that may not happen in the next 12 months, and there's other designations that may. So you have to take that all into consideration when you're going through this this process. I would recommend, as you are preparing your temporarily restricted schedules this year, that you're thinking about that and possibly even adding a column that says if this will be available in the next 12 months or not. I think that's going to help you when you get to coming up with this disclosure. Now to polling question number 3. Anyone adopted a liquidity policy? A, yes, B, is no. C is no, but will adopt prior to our year end. Time to respond to that. And right now I'm going to give you our second CPE word. Word is expenses. Expenses. EXP and SES. Okay, and we'll take a look here and see what our results are here in a minute to see if anyone has adopted a liquidity policy. Maybe. It looks like a large portion of us have not. 7% is no, and 27 is no. 25, is no, but will adopt prior to year end. So that is not completely surprising, and I think that that's something that we'll want to think about going forward as we go through this process. I still have a lot to get through, so I'm going to look through these examples pretty quickly. But the FASB example I've included here is an example of the liquidity disclosure. It does show on the left-hand side your quantitative disclosure, and then the right-hand side is your qualitative disclosure. And here it starts off with your financial assets at year end. And if you actually compare this to slide 15, which Terry presented, it matches right up. If you tie your total assets and you back out your investment in your prepaids and your fixed assets, you end up with this $234,000. Ultimately, then, you reduced it by those amounts that are unavailable for general expenditures. And they've broken them out between contractual or donor and then board designations. The sample here shows the qualitative portion that defines the policy it has. It goes into the fact that they do have a board designated piece for a liquidity reserve. And then it says at the end of this is in the event unanticipated liquidity needs, draw on their $10,000 of available line of credit. So they're addressing current and future policies. And there are several examples of liquidity here that are not FASB. Example 1, I think it's fair to point out that this one breaks out your financial assets. So it shows the detail of them, cash receivables, etc. But one thing in this example that is different that I think is important, instead of just putting in their investment balance, they basically included those that were going to be available or come from appropriations. And they've excluded, and not in the table, but they've excluded in the footnote in the qualitative piece of it, that there are other endowment funds, but that they are restricted. So therefore, they're not being used up in the top table to say they are available for general expenditure within 1 year. Go into some information on the board designated endowment, which they have not included on the table either, but does say at the very last sentence that these could be made available if necessary. Second example is very similar in nature. It just seems to me to be a little bit as complex as the first example, but again, it just shows you your financial assets available. If they do not intend to use board designated restricted cash, which I assume is on the face of their financial statements, and that's how you're identifying this, that is the reason it doesn't agree to the face, which the financial assets actually can be presented on the face of the financial statements as well. But in addition, this talks about their policy to 2 months of normal expenses, and it talks about the lines of credit that they could draw on in the event of an unanticipated liquidity need. Example 3 is different from the others. This in paragraph form. There is no requirement on how to present this. You just have to present qualitative and quantitative. So this one didn't use a table. They identify in the middle of the paragraph that they have financial assets of approximately $1 million, that they'll be able to conduct their mission during the next fiscal year. It even uses some different wording on it as well, but that is acceptable, and you may want to look at it that way if you have a more simplified version that you can present. And final example is very similar to the FASB example, but take a look at it. The only difference here is they've actually broken out their financial assets, and just start with a total. They show you what exactly makes those up, and they back off those that are unavailable for the next year. And then in this one, they do go in to say that their donor restricted endowments are not available for general expenditures. Some areas I think that will help you in coming up with your financial statement disclosure. Piece of the 2016-14 requirement is on the cash flow. They were thinking of requiring not-for-profits change to or use the direct method. In this case, they now have decided ultimately at the end of phase 1 that this is going to be based on the decision of the nonprofit themselves. They may choose to do the indirect or direct method. Now, most of our clients are on the indirect method, so that won't have any changes for them. The change is that if you do decide to do the direct method, you no longer have to present that indirect reconciliation that used to be required. It's important to note that this is what is required to be presented. If not-for-profit still wants to include that indirect reconciliation, they can use an optional disclosure. And it's also important to note that this only applies to not-for-profits. So those other reporting entities that are not-for-profits still have to provide that indirect reconciliation on their financial statements. And reporting of the expiration of capital restrictions. This is if an organization receives gifts or other assets to acquire or construct a long-lived asset, whether maybe it's money for a bank or maybe it's a donation to buy computers or a vehicle. To this, two options. The first option was to adopt an accounting policy that implied a time restriction that expired over the useful life of the donated asset. The second option was to adopt a policy that did not imply a time restriction, and the contribution was recorded as restricted and released when the property or equipment was purchased or placed into service. What I found is that both options were being used, but the second was predominantly used. And the new standard has done is eliminate that first option. So only the second option will be allowed. So you will be basically releasing those restrictions upon or when the asset is placed into service. One important note to note on this is that if the organization currently follows the first option, there will impact in the year that you implement the ASU. You will need to reclassify any balance in restricted net assets that relates to this implied time restriction, and the reclassification will go to your opening balances of net assets in the year of implementation. So what to do from here? We have a nice to-do list. First, to identify a champion, oversee this implementation, and management should be involved. There are different decisions that are going to have to be made, where it's the qualitative disclosure, et cetera, that you're going to want senior management to be involved in the process. You should review the FASB PDF version of ASU 26-14. It's not awful like some of the others. It's only 270 pages, and you can get through it pretty quickly. You need training to all staff. As I mentioned, that's not only the accounting staff, there's senior management, there's development. Everyone's going to be impacted by this, so they're going to want to understand how it affects them. Review systems in place and update internal controls as necessary. This comes into play if you've changed your, in the restrictions, if you did the implied time restriction release, you'll need to change your policy there. You may just need to change the terminology in controls because you may be referring to temporarily and permanently restricted. Stop the liquidity and what it means to your organization, both quantitatively and qualitatively. And consider adopting a liquidity policy. This is one I think that is going to be difficult. It's going to take some thought. You're going to want to know as an organization what this comes down to. So it's going to be something you want to do prior to year end. I would recommend even doing it now. There are organizations that this number may end up being negative at the end of the year. Maybe there's a chance that you can fix that before year end, or at least think about it and know what's happened, what to do at the end. And then just review your existing notes and financial statements. So ultimately making sure that they are in fact updated. I now go to our polling question number 4. The greatest hurdle to your organization's implementation of the new standard. A, changing net asset classifications. B, creating the liquidity footnote with qualitative and quantitative disclosures. Or C, the function expense statement with additional disclosures on allocation of costs. And get to think about that and see how that affects your organization. And in the meantime, I will give you the last CPE word for this presentation. Last CPE word is summer. M-M-E-R. Summer. So it looks like that the results of the poll show that most do feel that 30% feel that creating the liquidity footnote is going to be the greatest hurdle, which I would agree with. We have several that didn't answer, but I think that's ultimately what's going to cause you the most, which will take the most time. And quickly, just phase 2, what next? So Terry mentioned they had broken this project into two different phases. One is what we just went through. Phase 2 is what left that they hadn't decided to pass yet. And there's some things on operating measures, whether or not to require intermediate measures, and so whether and how to define such a measure for the nonprofits. There's some alignment of certain items on the cash flow and some possible segment reporting for not-for-profit healthcare entities. We deal with the anticipated completion date is for this. I went on to FASB's website just today just to see if they had begun anything with it, but the results were basically the board has not yet begun to deliberate phase 2. So we will keep you posted as we learn more and keep up to date of any new effects that phase 2 brings for the non-for-profit area. I am going to turn it over to Terry to talk about FASB's on the horizon.
As you can see here, we just wanted to end the presentation just to really kind of talk about, because the FASB has given us lots of things to think about over the next several years. So now that the financial statement presentation, ASU 2016-14, has begun for those December year ends, we wanted to kind of end the presentation just to remind everyone about two other ASUs that are on the horizons that are going to have some pretty big impact on some nonprofits particularly. So the first one here, we wanted to make reference to the ASU regarding revenue from contracts with customers. And as you can see at the very top, it makes reference to 2014-09, 2015-14, 2016-12, and 2016-20. All those are ASUs, and they've been updating, over the years based on this revenue from contracts. Now, it is not as simple or easy to read as the ASU on 2016-14 regarding the statement presentation for nonprofits. There's over 1,000 pages regarding this particular FASB accounting standard updates. So there's a lot of reading that has to be done to really get your arms wrapped around it. But we have been talking about it. Amy and I did a webinar this past December, and our firm will be doing another webinar regarding the revenue recognition later this year. But we wanted to remind you that it is on the horizon. The effective date will be for fiscal years beginning after December 15th of 2018. So those calendar year ends will be the first one to adopt in that 2019 timeframe. The vision does state that you should recognize the revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration the entity expects to be entitled in exchange for goods and services, and it requires you to use a 5-step process. But the one I wanted to make sure that everyone was aware of, there is a little bit of a qualifier in the effective date, and it's down here that we have in the note. So the date will change if you have a public company, nonprofit entity that has issued or conduit bond obligor for securities that are traded, listed, or quoted on an exchange or an over-the-counter market is considered to be a public entity. And that date is 1 year earlier. So the effective date for those nonprofit organizations that qualifies in this definition to be a public company, that does begin for fiscal years beginning after December 15, 2017. So what that means for those particular entities, it is in effect as of January 1 of 2018. So we just wanted to kind of highlight that. We don't have a lot of nonprofits that fall into this category that we work with, but we certainly have a couple. Make sure that you are aware of that if that does apply to your organization. We also want to just make sure that you understand that the revenue from contracts with customers, it does not apply to contributions. So those organizations that receive contributions, this does not apply. But what has come from all of the discussions around this particular FASB ASUs, an exposure clarifying the scope and accounting guidance for contributions received and contributions made has kind of arisen from out of this whole discussion around the revenue from contracts. And this exposure draft is still in draft form. They haven't finalized it, and so we're keeping an eye out, and we'll be reporting out to our clients as soon as there is clarification on this exposure draft. So just to keep an eye on that and start thinking about it as you are within your organization and getting prepared for this particular ASU. And the last to talk about and remind everyone is about lease accounting. And we all know this was being discussed for years and years and years and years, and they finally, they actually went live with it, and they came up with the ASU Topic 8.2, lease accounting. And the effective date for this particular ASU is for fiscal years beginning after December 15th of 2019. So calendar years in 2020 will be the first ones to implement this if there is not an early adoption. So under this particular lease, under this particular ASU, operating leases greater than 1 year will be included on the statement of financial position as right-of-use asset and a corresponding liability. So this is a pretty big change that will have to be made, and this goes out to non-for-profits and for-profits. So we have had a couple of nonprofits that has done an early implementation, and the calculation of the right-of-use asset and that corresponding liabilities does take some time. So if you are an organization that has these, you should start looking at those operating leases. And if you have multiple leases, you need to look at each individual one as you're going through and trying to determine what that calculation would be, because it is at the net present value of the asset. Again, it has that qualifier too. In the note, you'll see that the date does change if you have a public company and a nonprofit entity is considered, just like in the one before, if it's a conduit bond obligor for securities that are traded, listed, or quoted on an exchange, just like the one before. So I think we're at 12:01. We have not a lot of time for questions here. I'm going to turn it back over to Tom. And Tom?
All right, thanks so much, Terry. Before we wrap up today, like Terry had mentioned, we just want to answer a few of the questions submitted by our online participants and any others from in the room. Our first question is, my company is a September 30th year end. When to implement the new standard?
This one. So if you were a September year end, you want to start if you do not early implement, you'll start the ASU becomes effective October 1 of 2018 for your fiscal year ending September of 2019.
All right. Should we have a liquidity policy approved by the board of directors?
So I think that it doesn't state in the ASU that is a requirement. I think it's going to be a best practice that many organizations will implement, especially as they're working on coming up with the wording that they want to use in their liquidity disclosure. I think it's going to be a good idea to think about and have and be approved by your board of directors, but it is not required.
The last question, does the board of does board designated net assets come under net assets with or without restriction?
This one, the board designated net assets are included with your undesignated and board designated within the without restrictions under the new net asset class.
And just back on that, Terry, that does include board designated endowment funds.
Yes, absolutely. So as endowment funds, those are not true endowments that are designated by third-party donors. Absolutely.
We thank everyone for attending today's webinar. We encourage you to join us for our next event on June 7th on the complexity of expatriate taxation. Please check out our website for upcoming events and updates at www.grfcp.com/resources/events. No questions after today's program, please reach out to us. Our contact information appears here. Please remember to complete the electronic survey that follows if you'd like to earn CPE credit for today's webinar. Thank you for attending and have a great day.